George, it's great to have you back. Last time you were on, we discussed how the Fed must not become servants to the front end of the Fed funds futures and how the Fed has been confusing markets. Has anything changed? Do we still remain in what you described as a frustrating condition to watch?
Yeah, I think so. The lead up to the last Fed meeting at the end of July was much more confusing than the lead up to this one was. Part of that was the fact that they relied on New York Fed President Dudley to send, or sorry, not Dudley, Williams, excuse me, to send a specific message and telegraph what they wanted to do, which was cut. Williams basically blew the communication, and this time they had Powell do it. So Powell on Friday gave a pretty clear speech in which he didn't give any indication that they were going to disappoint markets, and so we can expect a quarter-point cut coming in the meeting this week. So the communications picture is much less painful this time around than it was going into the July meeting.
Yeah, you know, I sometimes think about some of the communication, the transparency, and all the insight that we've seen as far as discussion related to recent rates. And, you know, we've talked about the strength that we've been seeing related to some of the weakness in other foreign currencies, not necessarily tied to U.S. rates as of recent. I mean, is that what you're still seeing right now, George? More so the influencing factor behind the dollar being some of those other foreign currencies like the British pound, the euro, for example?
Yeah, so the British pound is very much being driven by idiosyncratic forces right now related to Brexit. So I think the British pound is the worst developed market currency to look at and get a feel for what the Fed's impact on the market is right now. So with regards to the euro, that's also a little bit muddied because of the evolution of the respective economies and how the ECB's reaction function. And the cleanest way to see that is to look at the euro Swiss franc cross. That's always sort of the best indication you're going to get as to risk sentiment and economic optimism for the euro area. And that cross has started to bottom out a little bit. So if you take that on advisement, basically the US dollar is pretty stable, maybe up a little bit. And that's consistent with what you see in terms of broad indices. So I like to look at the Bloomberg US dollar index, for instance, which is a 10 currency index that's weighted by liquidity and trade volumes. And that's up about 2.1% year over year so far in August, versus for the month of August. For the month of September, up more like, up more like 2.6%. The US dollar rising in the low single digits year over year is not going to cause any sort of massive shock to the economy, which wasn't the case in 2014 and 2015 as the hiking cycle kicked off and we saw commodity prices crash and the US manufacturing sector come under huge pressure from lower oil prices. So, yes, the US dollar is trending stronger, but it's not this rapid, persistent long-term gain that we saw earlier on in the Fed's hiking cycle.
George, does it have less impact on the economy, especially with rates at lower levels as well?
It's just, anytime a price moves, people adapt. And so the faster prices move and the longer they do that for. Yeah, that's what then when you get really big disruptions. If you're talking about low single digit price changes per year, if you're a major manufacturer in the US, that's not going to come out and destroy your bottom line. It may make things more challenging in the long run, but it's not something where you're suddenly saying, okay, well, we're now facing 30% lower revenues or clients are demanding, a massive price break or whatever. It's going to be a much slower moving process, which gives you time to adapt, find efficiencies elsewhere, pass on some of those profit problems on to your suppliers, and the whole system is just smoother. So for right now, the US dollar is still appreciating, but not doing so at a pace that we would be concerned with.
George, expectations for Mario Draghi and the ECB this week?
I think the risk is that they don't deliver a big enough and specific enough easing package. So the market sort of thinks that they're going to cut rates somewhere from 10 to 20 basis points, tier deposits to protect bank profitability, and then develop or unleash some sort of QE program. Now, if they're not buying corporates, buying government bonds, and doing so in decent size, if they don't cut rates, 20 basis points instead of 10 basis points, if they don't tier deposits, I think the risk is very much to a disappointment. And, ironically, I think that could mean a stronger euro versus the dollar because so much of the expectation around the ECB is baked into the euro dollar cross being lower. I think there's a substantial risk that they disappoint there, not because they're not going to ease, but because markets have really gotten aggressive about trying to figure out what the last sort of piece of fireworks from Mario Draghi in his tenure as ECB president is going to be.
Yeah, I'd imagine some anticipation of him leaving that position as well. George, I just wanted to get your final thoughts here in terms of what we should be talking about, because it's not only the ECB this week, we're talking the Fed next week. What are you going to be looking for?
So we're expecting another cut, but it's going to depend on what the dissents look like and how the Fed manages the expectations around what happens next. I think there's lots of room on the committee to agree on a quarter point cut this time around, a second quarter point cut. You may see dovish and hawkish dissents. And if you start seeing multiple dissents per meeting on either side of where things actually are, you're running into trouble in terms of finding working unified FOMC members to move policy forward one way or the other. So, we're not at that point yet, but it'll be really interesting to watch. If we get Bullard and Kashkari dissenting that they should have cut 50 bips, while you also have Rosengren and, say, Esther George dissenting that they shouldn't have cut at all, with the governors sort of all saying, 25 basis points is fine. How on earth are you supposed to guide what happens next? It's a big communications challenge. So watching the dissents is going to be important, and how Chair Powell sort of signals what's going to happen next in his press conference afterwards.